So let's talk about what no one talks about in investing. What is the step-by-step process to find the true worth of a company or the true value of a company? The true price or true worth or true value of any business or stock of a company is the present value of future cash flows of the business. This single line is the most important line for any investor in the world. Take any professional investor, hedge fund manager, money manager, analyst, anyone, and I mean all of them, by one way or another, value the stocks of the company by understanding this concept. Value of any company is the present value of the future cash flows that that company will have in its lifetime. So basically, the value of stock of company has two components. Number one, the present value, and number two, what are the future expected cash flows of that company. So let's understand first what are the future expected cash flows. Let's understand them by taking a very simple example. Let's say you open a McDuck burger joint and you say that I will run this burger joint for 5 years. Okay? And after 5 years, you will sell it. You invested $1 million of your money for a 5-year lease, building the shop, having the equipments to fry the burgers, and so many things which you require for running a burger shop. So what you have effectively done is that immediately you will have invested $1 million of your money, right? And let's assume that from year 1 to year 5, for 5 years, you expect that you will sell every single year 500,000 burgers. And your profit margin, or let's say your earnings on those burgers, will be 10 cents a burger. What I mean by that earnings is that once you, let's say you sell a burger for $1 and you have the expenses on that burger for making that burger, for labor and so many things, that comes to be 90 cents. So for every burger, you are earning 10 cents a burger. So your expected cash flows in year 1 will be on the sale of 500,000 burgers. After deducting all the expenses, you have the cash flow on first year as $50,000. And since you are selling the same burgers every single year for simplicity's sake, we are having the cash flows of $50,000 from year 1 to year 5. And let's assume that after year 5, you sold McDuck burger to Mr. Scrooge for $1 million, right? So at the end of year 5, as you have thought that you expect that you will be able to sell this burger joint to Mr. McDuck for $1 million. Now, this is what we exactly call your expected cash flows. So for year 1, your expected cash flows is $50,000. For year 2, again 50, year 3 50, year 4 50, and year 5, you have your $50,000, and because you have sold the burger joint, you get $1 million. So it's $1 million plus $50,000. So this is what we called your expected cash flows from the McDuck burger joint. And understand, when you value any business, be it McDuck burgers or Tesla Motors, this is what you are actually trying to find. You are trying to find these expected future cash flows. Now let's understand the second part, which is present value. Now present value is actually one of the most important concepts in finance. Let's understand it again by taking an example. So let's say instead of opening a burger joint, you approached Mr. Musk and asked him to give you $100. Mr. Musk says, okay, I will give you $100 provided you give me $108 a year later. In other words, Mr. Musk is asking an interest of 8% on $100 of loan to be given to you. Right? Easy enough. So if you ask or if you think from Mr. Musk's perspective, his cash flows will be something like this. In year 0, that is immediately, he will give you $100. That is, he will invest $100 in you, right? For you, it is loan. For him, it is an investment. And after year 1, you will give him a plus $108. So this is what the expected cash flows of Mr. Musk look like. Now, if I say, what is the present value of this $108 for Mr. Musk today? To get that present value, you will need something called a minimum required rate of return. Now, for simplicity's sake, let's assume that for every investment that Mr. Musk makes, he requires at least a 10% return on his investments. Remember, I told you, for you, this is a loan. For Mr. Musk, this is an investment. So, Mr. Musk will require at least 10% of this money which he has given to you. Now, the concept of present value is actually based on this simple line. A dollar today is worth more than a dollar in future. Let's say a year from now, right? Think about it. If I tell you you can have a dollar today, and if I tell you you can have a dollar 1 year from now, what will you choose? You will obviously choose a dollar today, right? So this is how the present value is calculated. The formula for calculating present value is the amount to be received in the future. In this case, this is the amount to be received at the end of year 1. So the amount to be received at the end of year 1, and we divide that amount, or you can say we multiply and 1 upon the amount, 1 plus the cost of capital or the minimum required rate of return on investments of the investor. In this case, that is Mr. Musk. So if you want to calculate the present value of this $108 for Mr. Musk today, what shall you do? Well, you will take this $108 which you will receive at the end of year 1. You will multiply and 1 by 1 plus 10%. Why 1 plus 10%? Because this is at least the minimum required rate of return which Mr. Musk require on all his investments. By doing this, you get the value of $108 to be $98.18. So what does that mean? That the value of $108 today, or the present value of $108, is $98 for Mr. Musk. It basically means that Mr. Musk is giving today $100 against the value of $98. So this is not a good investment for Mr. Musk. This is the essence of present value. You take the expected future cash flows and you discount them by multiplying these future expected cash flows with the cost of capital or the minimum required rate of return of investment. So to compute present value, we discount the future cash flows, that is $108, by the rate of return, that was 10%, which the investor require by investing in that company. One thing which I want you to understand about the rate of return is that it changes depending upon how risky the company you are valuing is. So for example, if you are investing in Tesla, that is a fairly safe company as compared to, let's say, you are investing in Severstal. What is Severstal? Severstal is one of the biggest Russian steel companies. Now, one of the Russia's biggest steel maker is a risky company today because of the geopolitical tensions. So, investing in Severstal will require a very high required rate of return as compared to, let's say, investing in Tesla. So, this is how the present value works. So, we discount the future cash flows of Severstal at much higher rate than, say, the future cash flows of Tesla. So, continuing with the example, let's find the value of McDuck burger joint if we have, let's say, a required rate of return of 10%. How will you do that? We already have the cash flows or the future expected cash flows we think we will get by investing in McDuck burger joints. Now, in the first year, since we have a required rate of return of 10%, we took 1 divided by 1 plus 1.10. And that comes out to be 1 by 1.1. So in the first year, the discounting factor is easy, right? 1 divided by 1 plus 10, that is a required rate of return. What happens in second year? Since everything compounds, this thing will also compound. The discounting factor also compounds. So 1.10, this amount will be basically again divided by the required rate of return, that is 1.10 square. And accordingly, we will take it to the period end, that is 5 years. So the present value of future cash flows becomes, we multiply $50,000 with the discounting factor and we get the present value of future cash flows. So for year 1, so this $50,000 which we will receive at the end of year, the present value of this $50,000 today for us is $45,455. The present value of $50,000 which we will receive after year 2 today will be $41,000 and so on. And did you see, the farther you go in your time period, the lesser the present value of the dollars becomes. For example, in the 4th year, the $50,000 present value is only around $34,000 as compared to $45,000 in year 1. So this is how the present value operates. Since in year 5, we were getting a huge amount, the present value dollars is only around $651,000 as compared to $1,050,000. When we add those all up, we get the value of MacDuck today at 10% required rate of return, and that comes out to be around $810,000. So what we are basically doing, we are getting a value of $810,000 by investing $1 million of our money. So that means it is not a good investment for us. Why? Because we require a return of 10% and the amount we are getting is not worth 10%. In reality, it is actually 5%. And that is why we are getting a lower value than what we put up. So for us, this opportunity is overpriced. Now let's assume that there's another investor whose required rate of return is only 5%. See what happens magically. We again have the future cash flows. The future cash flow doesn't change. And we have now the discount rate of factor that was 1.10 to 1.05. Now immediately the cash flows value increases. Why? Because the investor now requires only half the required rate of return. So cash flow values for year 1 from 45,000 becomes 47,000. Accordingly, like you can see, in 3rd year from 37,000 to 43,000, and the big terminal value, that is a value which we'll get at the end of year 5, from $651,000, it becomes $822,000. And how will you calculate the value of MacDuck now again? At 5% required rate of return? Again, we will just add these expected cash flows in the future. And voila, we get the exact value which we invested in. That is $1 million. That means the $1 million which we are investing today and the amount of expected cash flows we get in future from MacDuck equals the amount we are putting in. That means that we are actually earning a 5% return on this $1 million. Because this is the return, we have discounted our expected cash flows. So this proposal from being overpriced suddenly becomes fairly priced. And what do you think will happen if I take this 5% to 3%? Suddenly this proposal actually becomes undervalued. It becomes a very good investment for us because we require only a return of 3% and the project is giving a return of 5%. This, my friends, is the essence of how you calculate the intrinsic value of any company in the world.